Hi, everybody. Thank you for joining the session on mastering the stop loss. This is another part in the Crypto Quantamental Investment Education Series. The goal here today is after you all go through this presentation, maybe do some questions and answers, because this is, of course, live, that you guys will actually have a much better understanding on the stop loss. Certain topics that we're going to cover today are pretty basic to start with. So what is a stop loss? Then dive into the types of different stop loss orders, because that's very important to know. And then some very high level basics, such as when stop losses should be used. Then the reality is there's many different types of investment styles. Many of you are probably technicians. However, there's fundamental analysts and quants as well. We all use stop losses differently, and we all have different parameters to determine when we want to use stop losses. So how does different styles of investment utilize stop losses? And also there's a very big distinction between portfolio managers and day traders and how they utilize stop losses. So first we're going to kind of define the difference between the two, and then dive into when each uses stop losses and how they actually use them. Then lastly, I have a pretty decent section on when stop losses go wrong. This is probably the most important part of the entire presentation. What you need to really understand is stop losses are not some perfect solution to help you avoid loss. There are certainly things that can go wrong and do often go wrong. Now, all of this is just for informational purposes only. It's not financial advice. So keep that in mind. I'm just trying to help everyone understand and how to utilize stop losses. So please just use this as informational purposes. First and foremost here, please support everything I do. Follow me on Twitter. I have daily updates on my quantitative model that you can get the link, the Google Doc link, and there's plenty of videos and Twitter posts on how to utilize that model. At least how I do it. Again, informational purposes. And of course, check back for YouTube videos. I do quantitative model updates, buy, sell, and hold, and then fundamental analysis, maybe a funny video here and there, and then this educational series. So please join me as much as how often as you can, and please interact, questions and things like that, and it'll be great. So let's dive right into stop losses. I have 23 pages here to get through with you guys. So again, I'm happy to answer any questions you have, whatever. Just jump right in and we can kind of go back and forth. So I'm going to start really high level. What is a stop loss? So many of you probably already know, but some of you might not. So it's basically just an order that you placed to sell a security when it reaches a certain price. Now, mainly I'm going to talk from the long side, but you can also think of it as have a stop loss on a short as well. So if you're long, this is a price where you determine that you want to sell and get out of a losing position. Now, what's really important here, and I think I want to emphasize many times during this, is for portfolio managers, a stop loss may be part of your risk management plan. It cannot be your only risk management. Some portfolio managers actually do not use stop losses at all because they have a very robust risk management plan that takes into account many different things. They don't need stop losses. So keep that in mind. It cannot be your only part. Now, if you do not have a risk management plan, a stop loss is a critical first step, and it's a lot better than nothing. So if you're not really managing your risk from a portfolio context, certainly using stop losses is a good idea. So what about some stop loss orders? What are they? So really, it consists of two different actions. And this is, once we get to the point of what can go wrong, this is a critical component of understanding that. You have a limit or a market order. Now, if you're trading, you're a portfolio manager, you probably already know what a limit or market order is. I got a question about my echo in my audio. Well, I apologize. I got a new microphone. I'm sitting in a hotel room in New York, so you actually might get some friendly New York sounds, as well. such as police sirens and things like that. So I apologize for that. And, maybe I'll try to fix the sound, at some point. I'm not sure if there's much I can do at this point. So I apologize for that. But what about the different types of orders? So you have a limit or market order. Okay, thanks, Scott. Scott says the audio sounds good. So thank you. So you have the limit or market order, and then you'll have the stop. The stop is the price in which your limit or market order goes into effect. So here's a few examples. So Bob has a stop limit, Jane has a stop market, and Katie has a stop limit. They all have this position to protect their long position from loss. So in this example, Bob's limit order will go live at a stop at 6,300, and he will sell all the way down to 6,250. Jane's order will go live at 6,280 and will immediately fill at any price, wherever there's liquidity at that price. Katie's order would go live at 6,250, but she actually requires the price to rise before she begins to sell. So it's very important that you choose the order that you want, stop limit or stop market, and you carefully choose the prices, because it can your execution can vary dramatically. So what about the basics? When should stop losses be used? So the first point is if you're afraid of losing any more money. I would say this is the worst reason. And frankly, you should never, ever, ever have to use a stop loss because of this reason. This means you are over-invested, you have too much risk, you're over-levered, however you want to define it. Therefore, from a portfolio manager, a risk perspective, you need to solve that problem way before you get to the point of needing a stop loss. You need to reduce your risk, reduce your leverage, do a variety of different things to have a risk level that you're comfortable with, whether it's taking money out of whatever particular asset you're in and putting it in something safer, whether it's a US dollar or bonds or whatever it might be. So you need to keep that in mind. Okay, I got another chat about the audio problem. Everything's solved, so thank you. The problem of trading, you're having stop loss because you're afraid of losing any more money. It's an emotional, behavioral-based trading philosophy. And the reality is, if this is something you do, yeah, the stop loss is better than just emotionally trading and just getting totally blown up and wrecked in one swoop. But if you're doing this, you're going to die probably from 1,000 cuts. So please do not trade from a position of fear and a position of being afraid of losing any more money. Now, if that's the case, again, certainly use a stop loss, but try to rectify that beforehand. A main reason to utilize a stop loss is your thesis changed. So you're no longer confident that the reason you entered the trade remains true. Then also, maybe you have a predefined upside or downside range, or maybe that can be even targeted as a price or percent gain or loss. So you can put a stop there. What about technicians or chartists? What do they do and how? Scott asked, my talking from a TA perspective or QA, kind of all of the above. So the last slide is more broad. I'm actually going to dive into each perspective. So here's actually from a TA perspective. So what is a technician? They generally utilize pattern recognition and indicators derived from price or volume to develop a thesis on a particular asset. So here's a basic chart on a double top and double bottom. So you can see the double top, once the price breaks the neckline going down, they're shorting and they have a target and they would have a stop above the neckline, very predefined. And the stop would be set where they believe that the thesis changed and the pattern is no longer valid. So it can be very, very much hard-coded, very much this is the exact price that they want to get stopped out at. And the same in terms of taking profit from a target perspective. What about fundamental analysts? Now, most of you that are watching are probably more on the technical side, but the reality is there's a wide spectrum. And in the professional realm, there's probably a lot more people that do fundamental and quantitative analysis than technical trading these days. So I would say it's from a kind of amateur managing your own money. It's much more technical, professional. It's much more fundamental and quantitative. There's no right or wrong, but it's good to understand all the different perspectives. So what do fundamental analysts do? So they utilize in-depth qualitative or quantitative data on a company or coin, whether it's stock or crypto, to determine whether to buy or sell. This can also be FX or commodities, whatever it is. So here are some examples. So FA might include discounted cash flow for stocks that might do multiple analysis. So you're looking at the price to earnings ratio of Walmart versus other kind of big box retailers. Financial statement analysis, listening to conference calls, understanding the personalities of people in the C-suite. There's a lot of different things that can go into fundamentals when you talk about stocks. What about crypto? That's a little bit more challenging, at least these days. But you can look at things like team size, qualifications, GitHub activity, maybe their coin or token distribution, demand analysis, as in does it have enterprise use, adoption, mainnet, testnet, things like that. So how do they actually use a stop loss in this case? So generally, fundamental analysts are much more likely to institute, we call it a review, versus a automated hard stop loss. So a review would be they would dive into the coin or stock and determine whether or not to continue to hold or if they need to sell. So what might trigger some sort of review? It could be an absolute price decline. So Walmart or a crypto declines 10%, and 10% is the line in the sand, would trigger a review. What about something like a relative price decline? So portfolio managers probably care more about relative than absolute. So in this case, it would be looking at the returns of Walmart versus Target. So if the market's up 20 and Target's up 25, and big box retailers are generally 25, but Walmart is only up 10, they're lagging tremendously, even though they're up. So being up is not good enough. An FA analyst would go in and say, okay, why are they lagging? Why are they underperforming? And perhaps sell based upon a trigger. Certain other things might constitute a trigger. It could be a unexpected volume spike on a name or a coin. Might be a cause to dive deeper and potentially sell. Also news flow. So there's metrics, especially for stocks. You can look at how often a stock is mentioned in the news. You can see Google Trends. You can see how often it's popping up in Twitter, things like that. And if that's unexpected, you can also dive in to see if something's going on. In extreme cases, though, fundamental analysts may utilize a stop loss, like a hard-coded stop loss. And they would do this primarily as an ego check against their own behavioral biases. So fundamental analysts, generally, because they're utilizing their own judgment, and yes, they're using data, but it's their judgment on top of the data. They recognize they might have confirmation bias or overconfidence bias. Confirmation bias would mean that in this review process, they might actually be unintentionally looking for data that supports their own thesis. And overconfidence bias would be exactly that. They believe in their own analysis more than they should. So they might institute a hard stop loss, in this case, to overcome that bias. Now, that the price here that determines the stop loss wouldn't be based upon technicals, but generally some sort of loss amount. So whether it's an absolute loss below zero or a relative return loss, they would have that kind of hard-coded in their system. So say if it's underperforming or has a loss of 10%, automatic sell. However, more likely than not, it's going to be more of the review process. What about quants? How do we use stop losses? So, my name is Crypto Quantamental. So that's actually the second part of my name. It's a blend of quantitative and fundamental. So that's primarily what I do in my professional and in my crypto life, where I would say the vast majority of my work is probably quantitative, but I also do fundamental as well. So how do And what are quants? So quants utilize statistical analysis across all investable assets throughout time to determine which assets are most favorable. These signals can be things in the FA analysts use or TA analysts use, and they basically blend them together. A huge advantage of quants over both TA and FA is scale. You can do a lot of analysis across many different assets in a short period of time. The disadvantage of that would be, say, a fundamental analyst would be able to go much deeper into a particular asset than a quant could. So in regards to a stop loss, quants would use similar triggers as fundamental analysts. So how much a stock is down, maybe we'll do a review. If it's a relative loss, maybe a review, higher news flow, etc. However, a quant is much, much more likely to have, again, what I would call hard-coded stop losses, not to review, than fundamental analysts. Why? Because a quant is much less qualified to do the FA work required for a proper review. And then also, if an asset is behaving unexpectedly, so it's down a lot and the market's up, or like I mentioned before, Walmart's up 10, but Target's up 25. If it's behaving unexpectedly, then likely there's something that's happening that's not in the model. The model is missing something. So if that's the case, there's no need to be in the stock anyways. And then also, there's very little difference between an asset in the model and then I'm going to call it the next man up. So in my quantitative model I share with you guys, you can see I have the top 10%, top 0 to 25%. And let's just assume you're able to perfectly invest in the top 10% of coins or stocks, whatever it is, every day, every week, every month. Well, if something happens to one of those assets, well, number 11 on the list is, from a quantitative standpoint, not much different than number 10 or number 9 or number 8. So we're perfectly okay including number 11. So if there's a problem with number 8, it's not even worth the time in many cases. Just boot it out and put in number 11. In terms of the price set, again, this is very predetermined if a quant wants to utilize a hard stop loss. So what about portfolio managers versus day traders? So the vast majority of you might probably consider yourself a day trader. If somebody actually called me day trader, I might actually get a little offended, to be honest with you. But what's the quick definition? Now, this is very, very high level. We can get a lot deeper than this. But day traders generally only have a few positions open at a time, with the bulk of their money in the benchmark asset. So that's usually, say, the US dollar, but it could be Bitcoin or the S&P 500. So let's just imagine a world where you have $10,000, you have that in your trading account, and a day trader might enter in a position for $1,000 at a time, and another $9,000 still might be in cash. Where a portfolio manager is going to have many positions open in order to beat the benchmark. Now, the benchmark for portfolio managers is much broader than day traders, so it could be against the US dollar, but it's much more likely it could be against Bitcoin, it could be against the whole crypto universe, it could be against the S&P 500, it can be against global equities, it can be against 60% equities, 40% bonds, it could be a blend of anything. But the point is they have many, many positions open in order to beat that benchmark. And the risk philosophy is a lot different. And you can see this on Twitter, and there's videos out there as well, where the day trader mindset and approach to risk management is this. They're worried about the risk of a single position, just the one position they have open, or the two, whatever it is. Where portfolio managers are much, much, much more concerned about the risk of the entire portfolio. That's a very critical distinction. In terms of risk to return, portfolio managers generally have a much higher return and therefore risk targets than day traders. Like I mentioned before, PMs typically have a broader benchmark to beat, whether it's S&P 500, so on and so forth. Day traders are more absolute return oriented, so they just want to make positive returns. They're not trying to, they don't want to go negative, they just want to be positive. Where portfolio managers, in many cases, are okay being negative if their benchmark is negative as well. They just want to beat that. So therefore, the risk and return goals of day traders is much lower than PMs. It's not always the case, but generally. And then also portfolio managers can be absolute return oriented as well. A lot of hedge funds are, where they're just trying to produce a positive return. So here's a very important thing. Now, I know I kind of BS on Twitter, and sometimes I'm serious, sometimes I'm not. But more than anything, the most important thing any of you can do investing, whether it's stocks, crypto, real estate, is this. Do you know what your benchmark is? Do you know what you're trying to achieve? What are your goals? What is your return target? What is your risk target? How much downside are you willing to stomach? Things like that. And if you do not know that, you need to figure that out immediately. Really, you can't do anything realistically without knowing that. You're just kind of running blind. And certain things to kind of help you figure it out. You have a lot of positions open, do a few, and that might help you determine if you're a PM or day trader. Generally, if you have a few and you have offsetting positions, longs and shorts, you might be a day trader. And then are you trying to get small gains first, beating something related to the market? That's, again, a difference between kind of PM day trader, somebody that's maybe trying to beat the crypto universe or trying to beat the S&P 500. But regardless, you need to know what your benchmark is, because if you don't, it's very hard to even understand the types of stop losses, where to set your stop losses, when to set your stop losses if you don't know your benchmark. And also, this is very important, the term trader has multiple definitions. So in the vast majority of the financial profession, a trader is just somebody that takes an order from a portfolio manager, is tasked with executing that order. Sometimes the PM could be the trader as well. Sometimes the trader has discretion, so he can look at TA, he can source liquidity, he can do a lot of things. Sometimes the trader is just a, want to call it like a paper pusher, so he'll just get the order and execute. So this part right here is more for the younger people that might be watching, or people looking for a career change. But if you're looking for jobs in the trading industry, you really have to understand what type of trading you want to do. So there's nothing wrong with even just being a pure executor trader. They make a fair amount of money, but that's great. But you have to understand, you want to be a trader that takes orders, so you're not determining buys and sells. You take the order and you just determine the best way to execute, or you're okay just executing via market, or do you want to be a trader that might be more similar to what you think in terms of what you see on Twitter or other places? And that's, like say in the hedge fund world, the terms portfolio manager and trader might be interchanged. Chris just asked if there will be a replay. Yep, there will be. So you can watch this as many times as you want. And then you can always ask questions via DM or on Twitter. What about day traders and stop losses? So remember, these guys are generally trying to make small gains and beat cash. Now in crypto, with such high volatility, your small gain is relative to your volatility, so it's a bit bigger, but generally much lower risk and return target. Well, day traders typically have a stop loss in effect for each trade. So this is a key component of their risk management policy, because they're focused on risk trade by trade, asset by asset. Now, the best day traders are already going to have a predefined downside or risk allocated to each trade. So for example, a day trader that only wishes to risk 2% of his capital on his trade can easily calculate the price for which a 2% loss of his capital would occur, and he can just set a stop right there. Although I would actually recommend, and I'll show you why, I would actually try to be fancy with my stop losses a little bit to make sure I get execution, or better chance of execution, with a 2% loss. A day trader will often move his stop losses up to lock in profits, because again, his goal is to make small gains. So if he has a small gain on a position, lock it in. Most day traders are typically technicians. So they have stop losses where their charts become invalid. That's very common. And then just a quick note, something like on BitMEX, where you lose your entire margin if you get liquidated, a stop loss is certainly preferred. Of course, that could be day traders, portfolio managers too, so just keep that in mind. So it depends. I mean, know your rules depending on where you're trading, so things can change. What about portfolio managers and stop losses? So I'll mention this again. As a portfolio manager, meaning you have many different assets, and I would argue all of us are portfolio managers, because even if you only have a few assets that you're trading in crypto, you might have a home that you might have a 401k, you might have some stocks somewhere, you might have another retirement plan, you might have a savings account. It's called mental accounting if you segregate all your assets in different buckets, and that's inefficient. So you should really be thinking about your entire net worth and how to optimize that, which would make you a portfolio manager. So here, stop losses, again, might be part of your plan, but they're not sufficient for a full risk management plan. It's barely scratching the surface. So managing a portfolio is a totally different skill set than just making buy and sell calls. Now, there's a lot of overlap. So here underneath, I have the styles or different potential roles of people and where they fit into the portfolio manager structure. So generally, at many investment management shops, you might have analysts, you might have a portfolio manager, maybe you have a trader, could be the same person. But analysts, they could be quants, they could be technicians, they could be fundamental. Analysts generally just make buy or sell calls. That's buy, Ethereum, that's buy Walmart, that's buy Target, and here's why. Whether it's a technician, fundamental, or quant. Now, there's some overlap. On the far right-hand side, you have portfolio risk managers. Well, these guys generally don't have the qualifications to make buy or sell calls. Their skill is blending assets and creating a kind of a full comprehensive risk plan. So making sure the blend of Target, Walmart, Ethereum, Johnson & Johnson, whatever it is, they blend together in such a way that the risk is where you want it to be. That is their skill set. Quants kind of fit in the middle. Now there's overlap here. So like I mentioned before, I'm quant mental. I have some quant and some fundamental in me. So it's not just one and the other. But quants generally can be an analyst. We can certainly pick what stocks to buy or sell, but we have the mathematical skills to build and construct portfolios and understand our risk. Now, certainly technicians can have that math skill as well. So that's why it's basically a Venn diagram. There's a blend, but there's technicians that don't have that math skill. They might just be able to recognize patterns and say, this stock is a buy. But that alone isn't sufficient to build a portfolio. You need somebody that can take all that information and put it together. The same on the fundamental side, might be a guy that does a fantastic job, understanding competitive positions of stocks, but that doesn't mean they know how to blend stocks together. Where quants, literally, probably by definition, have the skills to do both. So what about portfolio managers and stop losses? So the reason why I put technicians, fundamental, quant on the previous page is depending on what type of investor you are, that's generally how you would use your stop loss as a portfolio manager, potentially. That's why this section actually came after the previous section. However, the key point here is whether you're a technician that knows some math and you're building portfolio, or a quant, or a fundamental analyst. If you're truly managing a portfolio of assets, you should be much more concerned about the portfolio risk level and that your portfolio is properly aligned to where you want it to be in terms of downside risk, in terms of the bets that you're taking, whether it's sectors or asset classes, crypto or stocks or bonds, than individual assets. So, I have a couple kind of blurbs down below. Let's just imagine I'm a pretty boring S&P 500 manager, and I'm just trying to beat the S&P 500. So I have some tech stocks, and I have some telecom stocks, utility stocks, and consumer staples and consumer discretionary and healthcare and financials, etc. A whole portfolio. Well, what if a tech stock got stopped out? Say it's a bear market, things are tanking, and one of my tech stocks really plummeted, and we stopped it out. Well, then what? What do? Who decides what you do with that extra cash? If you went to cash, then your portfolio risk will be almost certainly be too low, because now you're deviating from your strategy, your benchmark a bit. But say you took that cash and you bought a utility stock, and most likely if you're in a bear market and stocks are tanking, utility stocks are doing well. So, okay, you plowed your money into what's working, what's trending. But now your portfolio risk might actually be too low. So if the market turns around, you're going to underperform because you don't have enough risk. And that's the worst case, because you're going to get whipsawed. You lose on the downside, then you'll lose on the upside, you'll get fired. And also, you might have unintended sector bets. So before the stop loss went into effect, you had your optimal idea of how much tech you wanted and how much utilities you wanted. But if you rolled that tech name into an utility name, all of a sudden, that seesaw got a little unbalanced. So these are things portfolio managers have to think about. And then portfolio managers also have to calibrate their position sizes very carefully, and also their stop losses. So the reality is all assets have different volatilities. So bonds are a lot less risky than stocks, which are a lot less risky than crypto. So a 3% loss in a bond is a much bigger deal than a 3% loss in a stock, which is a much bigger deal than a 3% loss in crypto. That could happen in crypto for no reason, just for literally no reason. So you have to keep that in mind, that each asset has different volatility, and you have to calibrate your stop losses to take that into account. Also, I mentioned this before, but relative stop losses. PMs are much more concerned about relative stop losses than day traders. Remember, day traders typically are just trying to make an absolute return, a positive return. They're not, their benchmark is cash. So they might not care if Walmart is up 10, but Target's up 25. If they own Walmart, they just see, oh, we're up 10. Great job, high five. But a portfolio manager thinks about it a bit different. In that case, they might be, wow, Walmart's up 10, Target's up 25, what's going on? And they might actually have hard-coded stop losses to take that into account. So what about when portfolio managers might not use stop losses? Kind of mentioned a little bit, but again, very focused on portfolio level risk. So in order to do that, you have to understand how assets move together. So do they zigzag? Does one go up, another one goes down? And it's very important to know, this is almost like a central tenet to good portfolio management. It's okay for part of your portfolio to lose in order to win bigger elsewhere, kind of lose the battle to win the war type thing. So keep that in mind. So you don't want to just stop loss the losing battle to win the war, because that might screw up everything basically. So here's another decent example here. So say I'm a multi-asset class manager, and I have tech and some bonds, and maybe I have crypto and a lot of other things too. But let's just think about tech and bonds here. So in extreme market conditions, these two assets move in different directions. So if the market is way up, treasuries might be slightly up or down. But if the market's way down, more than likely treasuries are going to be up. And treasuries generally protect you in drawdowns and downside events. So let's think about this. So if you're in a bull market, the economy is going great, tech is kicking butt, what might happen? The Fed might raise rates, even though people watching this might not like central banks, but the Fed might raise rates, interest rates go up, and your bonds, the value of bonds that you're currently holding, might go down. You might be losing money on your bonds. Okay, so let's put a stop loss on it. Take them out of our portfolio and put it in equities or put it somewhere else, doesn't really matter. What I would argue here and the data would show this, that if you stop loss your bonds and took out those long-term treasuries, you're actually increasing your risk. So your stop loss here, in this case, would be doing the exact opposite of what you're trying to intend. So I mentioned before, treasuries do bad if rates are going up and the economy is doing fantastic. Well, the opposite is true. So if you're in a recessionary period and the Fed is cutting rates, your treasuries are going to do very, very well. And what's interesting here is when that's happening and you're in a recession, maybe even a depression, your stocks are going down. You're losing money on that side of your book. Your downside risk is actually the highest because stocks have much higher volatility than bonds. So you really want to have those treasuries in your portfolio to protect you against that drawdown. But if you stopped them out before and they're gone, you don't have that cushion. So your risk is much higher, your drawdown is much higher. So you have to, again, very important to keep it in mind. You have to think about the entire portfolio. Here's another example on something that certainly does not require a stop loss. So, I mentioned portfolio managers can also be absolute return. So just trying to gain a positive return. So generally those strategies would be called like maybe market neutral. So they take a long and a short exposure, and when they net it out, you have no exposure to the market. So say I'm long Walmart and short Target. I don't really have any market exposure. Now, if I have 50 longs and 50 shorts, I'm a portfolio manager, and but I don't have any market exposure. I'm just trying to earn the spread between my longs and shorts. So here's a couple examples. So I have crypto and the Walmart and Target example. So say I'm long Bitcoin, short Ethereum. Example 1, it's a bull market. Bitcoin goes up 80, Ethereum goes up 75. So I make 80 on my long Bitcoin trade and I lose 75 on my short Ethereum trade. I actually make 5%. But if I stopped out my Ethereum trade, then the entire trade would break. Then I'm no longer market neutral. I have a very distinct market bias. In this case, the market bias was very, very positive. But that wasn't my intention in the trade. So you certainly do not want to stop out the trade. What about on the other side where the market goes down? So say I'm long Bitcoin, but it goes down 65%, so I lose 65. Short Ethereum goes down 90, kind of like what's happening now. In that case, I make 90, but I net it out to be 25. Again, if I stopped out my long Bitcoin exposure, well, then I have a very biased portfolio, a bear biased portfolio. That's not my strategy here. I'm trying to capture the spread. So what do portfolio managers actually care about when they're trying to do things like this? So you can see example 2, the bottom part, where long Walmart down 30, short Target down 20. So you're actually down 10% on your spread. So a portfolio manager would actually care much more about, and even a trader that's thinking about this should care a lot more about the performance of the trade as a whole, the down 10. If that spread moves against you in such a degree, that might trigger a stop loss, but not the individual asset. Hopefully that makes sense to you guys. Now, what's interesting is many people I talk to, especially in the crypto space, they're actually doing a lot of this without realizing it. And their trades are getting out of whack because they're not managing them properly. They might be very much long short. They might have 3 longs open and 3 shorts open. But they're not realizing that they're actually market neutral. They're not taking any directional bias on crypto. They're just actually capturing the spread. And I've actually seen this happen, and I get a chuckle, and it kind of makes me sad that some people are chasing some clout, and they're basically tricking people. Might not be intentional. They just might not know any better. But they might say, oh, I'm long Bitcoin and short Ethereum. Okay. Well, if Bitcoin, in my example, I don't have this listed, but say Bitcoin goes up 20 and Ethereum goes up 30, then they'll be like, oh, look at my great call on Bitcoin. It's up 20. No. Like your trade, your spread lost money. It was a poor trade. So you have to be very careful in what you hear, and because you don't really necessarily know exactly how portfolios are structured and what trades they're actually trying to do. So just keep that in mind. Hedges do not require stop losses as well. So here, just to imagine a farmer, call him Bob, that grows wheat. Harvest is months away, and he wants to lock in the price he'll get for his wheat. So say he wants to get 50 grand, which is basically the price of wheat multiplied by how much wheat he's harvesting. And that 50 grand is going to pay plenty of money to pay for his family. Okay. And he's happy with it. And he does not want any market exposure. So he can actually enter into a derivative contract to sell 50 grand worth of wheat when he gets to harvest. This will actually lock in his price. So you certainly do not want a stop loss here. So if the price of wheat increased to 80,000, in this case, he's down 30 grand on his derivative contract, right? Because he went short and the price went up. So he's down 30 grand. But when he actually harvests, actually gets his physical wheat, he can go to the market and sell it for 80 grand. So, 80,000 profit from selling the physical wheat, and the loss of 30,000 on the contract equals what? 50,000, the exact price he wanted. So he's locking in his price. So if he entered in a stop loss in this case, it would have broke his hedge, and that's exactly what he's trying to avoid. So this is actually, I would argue, the most important part for most of you. But what can go wrong with stop losses? Many people treat them as a crutch. You have a stop loss at X price, which means you're going to get executed at X, and that's great. But that's not really the case, not always the case. So, but what could go wrong? So one could be your stop loss could be way too tight, so too close to the price that you entered. And here you can get stopped out just due to random variation, just randomness. So your call could be perfectly right, your analysis could be perfectly right, and you still lose because of randomness. For example, Bitcoin has an average daily volatility of about 4%. Now, last I looked, price is about 6,300. If you wanted to go long, but you're scared of losing money, so you put a stop loss market, in this case, 62.75. That's 0.4% away from the current price. Now, just looking at daily closes, because the math is easy here, Bitcoin will actually close lower than your stock price about 49.6% of days. So basically half the time, it's going to close lower than your stock price. Then you have intraday volatility, which that is massive as well. So the reality in this case, if you set that stop loss 0.4% away, 62.75 or 6,300, you're going to get stopped out basically every day. So you're going to basically die from 1,000 cuts. Maybe you get lucky one time and the price keeps going up and you don't get chopped out due to random variation, but you're going to get just the 1,000 cuts and you're eventually going to go bust if your stop losses are too tight. Then you have the Wick problem, where stop losses can go wrong. So as we all know, Wicks are short-term, high volatility movements that move price in an extreme direction and then quickly reverses. In crypto, this happens all the time. It can be with an illiquid coin. Somebody just blasts a huge market order. You have BitMEX, has long books all the time, mainly because of cascading stops, which we'll get to. And also, but for stocks, if you're dealing with like large cap stocks, things like that, you generally don't get huge short term. I'm talking 1, 2, 3, 4, 5, 10-minute huge wicks. But it's certainly possible if you're trading less liquid, small cap, micro cap names. So I have a chart here, and this is a 5-minute chart, BitMEX, and I don't have the exact date on here, but I circled a couple wicks where the price quickly reverses twice. And these are 5 minutes. So within a 30-minute span, you get a pretty large down move and a pretty large up move. So if you have even a reasonable stop loss, you can get wicked out here. Now, if you have a tight stop loss, you're screwed for all intents and purposes. You're certainly going to get stopped out, and this is kind of my what I mentioned, kind of random variation. The price basically ends up in the same spot, and you have quite a bit of moves, so you can get wicked out, or your tight stop loss will trigger. So that's certainly something that can go wrong. But also, I would say the next two slides are the two biggest problems. One would be no execution. So you might say, hey, crypto QF, how can I get no X on my stop loss? Well, if you utilize a stop limit, I put limit twice on there, but a stop loss limit order. So remember, at your stop price, your limit order goes live. Execution will only occur up to your limit price. So it depends, exactly how you place your limit. But remember, at that point, it's just a plain Jane limit order. So let's walk through an example here. You can see how this works in practice. So let's just assume, again, we can talk Bitcoin or whatever asset. Just imagine a price of 64.30. And we have 3 people here. We have Bob, Amanda, and John, just made up 3 names. They're all long, so let's just keep this simple. And they all want stop losses to protect their long order. So what happens if Bob has a stop loss? With the stop at 64.30 and a limit down to 6,400 for 5 units, or let's just call this 5 Bitcoin. Amanda has a stop loss limit as well, but she has her stop at 64.20 and also a limit down to 6,400. John has a stop order at 64.20, but his limit is at 64.30. So he needs the price to rise to actually sell. So what happens at 64.30? So immediately Bob's stop goes into effect first, and his becomes a limit order. So his limit is actually going to execute all the way down to 6,400. But he runs out of liquidity. There's not enough to be sold down there. So he only sells 2.75 Bitcoin and has 2.25 left over in his wallet, his exchange, or whatever you want to, wherever he's storing at this point. What about Amanda? So remember, Bob just executed all the way down to 6,400 because his stop was first. As that's happening, Amanda's stop goes into effect at 64.20, turns into limit down to 6,400, and it some exchange differs, and I have a typo here, but Bob ate the liquidity down to 6,400. She does not, or may not, depending on the exchange, get anything filled. And even if she gets something filled, it's not going to be anywhere near her full allocation. So what about John in this case? So John's stop goes into effect at 64.20. His sell price 64.30. Like I mentioned before, he wants to actually sell when the price goes up. But the problem now, in John's mind, he set the stop 64.20, and he's only $10 away. So just maybe a little chop will give him a little better execution. But due to the other stop losses and the other market activity, the price has dropped to 6,400. Now, instead of him thinking he's $10 away from execution, he's actually $30 away from execution. And his limit order just might not get filled, especially if the price continues to go down. So you might not get any execution. What about stop loss market order? And again, another typo. I'm terrible at proofreading. So this should say stop loss market orders. So what can happen here is bad execution. So again, you have your stop price, but here it's a market order. So it just goes live. You get filled at whatever price. So in a fast moving market, you might get execution a lot worse than your stop price. So this here is really a complete illusion of safety. Keep that in mind. So this is actually one mechanism that can cause a short squeeze as well, or any directionality of a squeeze. So here we just have two people. So we have Bob and Amanda again, 64.30 at price. So what if Bob sets his stop at 64.30, market order, 5 Bitcoin, Amanda 64.20, 4 Bitcoin. So here Bob's stop goes into effect at 64.30 and turns into a market order. His 5 Bitcoin market order is going to eat up all the liquidity down to 63.80. You can see the table to the left, kind of the red font is what Bob just ate up. You can see the bid sum, so that's the sum of the Bitcoin available. So he eats up all that. So his average execution here is 64.02. Now he set a stop loss market at 64.30. So he had $28 of slippage here between where he set a stop loss and where it got executed. But it's a lot worse for Amanda. So her stop loss market order goes into effect at 64.20, turns into a market order. But remember, Bob already ate all the liquidity all the way down to 63.80, 63.70, depending on he's going to get the next execution to 63.70. So she gets filled at 63.70 and finishes all the way down to 63.20. So her average execution here is 63.50 versus a stop order at 64.20. So a huge amount of slippage here. So you have to keep that in mind, that especially if you're trading leverage on something like BitMEX, you can get very much caught in this cascading of stops, and your execution can be far, far worse than what your stop loss market order might be. And if you set a stop loss limit order, you might not actually get executed at all. So those are huge potential problems, and that's one reason why you cannot use a stop loss as a crutch. You need to have a good risk management plan that takes into account the downside of your portfolio, the potential risk of your portfolio, all the different bets you're taking in terms of different sectors, different asset classes, even in crypto. Are you overweight currencies versus platforms, or what about do you have too many ERC20 tokens, things like that. So you have to keep all that in mind when you're actually building a portfolio. And that's what kind of risk manager would think about. Sure, they might certainly use stop losses in particular times, but you have to recognize that they can certainly go wrong and certain ways to help protect yourself. So that wraps up the presentation today. I certainly appreciate all of you for joining. If you have any questions, feel free to reach out to me. Of course, you can watch the replay, and hopefully the crypto markets and the stock market, for that matter, do pretty well today and next week and month. So you guys take care, and I will talk to you soon.